The questions today are very important for all of you ETF investors out there. And they have to do with the idea of, can we lose all of our money by investing in these ETFs? Like if the S&P 500 or VOO just goes out of business or goes down to zero, can we lose all of our money? And another question that I'm going to be answering as well has to do with the fact that as it's dropping or as it's rising, should we be dollar cost averaging? Should we just buy a bunch at the bottom? How should we do this and what's the best way? So they kind of work together, and so today you're going to get two questions answered in this one office hours. And once again, this is office hours. This is the time where I pick one or two questions from the week to go ahead and answer in an unedited, just one take format, as if you came into my office just like my students do after the lecture and want to go a little deeper into a subject. So today I have my laptop open since I am going to be doing two different questions, and so I want to ask the question exactly as it is and then be able to give you my answer on it. So the first one says, can an ETF issuer be vanished and we lose all of our savings? And this person's talking about investing in SCHD and SPY, which is the S&P 500, the total stock market, different things, international funds, different types of funds. And this is a great question because if you're investing in something, you're definitely not wanting it to ever be able to go to zero or be able to lose all of your money. Now, just as a forewarning, when you invest, it doesn't mean that you for sure will get any gain. There's also a very, very small chance that you might lose all of your money or most of your money or some of your money. Now, what we try to do here is mitigate that risk into the best possible investments. But just know that if you ever do invest, it doesn't mean that you have to make money. So anyway, if we're talking about something like the S&P 500 going to zero, the idea there is that we have to understand what the S&P 500 is. That is an actively managed indexed fund, right? And so what it's indexing is the 500 top companies in the United States by market cap, and it's actively managing that, which means that if a company starts just dying, right, a company starts really losing market share and losing value, then they get kicked out of the S&P 500 and a company that's doing well gets brought in. And so that's happening without you having to do anything. They're actively managing that specifically. And so it's highly, highly, highly unlikely that our 500 top companies in the United States just out of nowhere die out and go to zero. If that does happen, that means that probably everything is dying out and going to zero, and we have some kind of zombie apocalypse, and so we have bigger problems. The main thing that I want you to get out of understanding investing into any of these types of ETFs or index funds or whatever is that they're tracking an index fund which tracks a bunch of different companies that are actual real companies and their progress and their profit and things like that. So the companies themselves, the individual companies, the Apples, the Microsoft, the Home Depot, those could go out of business. Yes, you could lose a lot of money by investing in that individually, but when it's an index fund or an ETF, the reason why it's so safe is because it's highly unlikely that all of those are going to just drop out. Now, the question specifically here is more talking about the actual ETF issuer. So like Vanguard would be the one that holds VOO or VTI, or Charles Schwab does SCHD. And so what I think that they're asking here, what I think you're asking is if that specific Vanguard goes out of business, can you lose all of your money? And the quick answer on that is no, because the idea is, and I found this, I researched this just like you guys should research when you have a question, but I researched this up and it says Vanguard's paid by the funds to provide administration and other services. If Vanguard ever did go bankrupt, the funds would not be affected and would simply hire another firm to provide these services. So Vanguard is just kind of like a holding. It's just something where they are being able to put what is being indexed into a package that you're able to invest into. But they're federally insured, and again, it wouldn't just happen overnight. It wouldn't just be like the S&P 500 just totally went to zero in one day. It would be a slide and you would see it happening. And so most likely you'd either take your money out if something crazy was happening, or you'd be able, or the company, Vanguard themselves, would start to see like, oh, we're losing, we're dying something, right? And so they would figure it out and get a different management company in there or something. So all that to say, it's highly, highly, highly unlikely. I'm not going to say 100% that you won't lose your money. You do need to be actively just kind of like watching and making sure you know what's happening. But for the most part, it's one of the safest investments that you can do in index fund or ETFs. Now, on to the second question here. What this person asked was, can you talk about increasing dollar cost averaging, DCA, amount as the market downturns? So as in not trying to time the market, but you simply increase the amount of dollars you're dollar cost averaging, maybe in layers. And this is really, really smart. So first of all, dollar cost averaging is just, let's say you have $1,000 that you'd like to invest at some point. Instead of putting that $1,000 in today, maybe you put $100 in every Monday for the next 10 weeks. And so what happens there is if the market goes up, or the market goes down, you're basically getting an average price of up and down of that whole 10 weeks. Because the problem is if you just put that $1,000 in today and then the market just drops like 10% tomorrow, you've basically just lost 10% of that $1,000 for the time being until it comes back up. But dollar cost averaging is something that I totally recommend. It's something I personally do every single month. Every one of my paychecks, anytime I get paid by clients, a piece of that goes into usually ETFs, but other investments as well. And so what this person is asking is, as the market is downturning, as it's dropping more and basically more on sale, should you increase that dollar cost averaging? Should you put more into it? And in my personal opinion, I say yes, if you can afford it, if you've done all the other things, if you don't have bad consumer debt, you don't have credit card debt that's crazy, you don't have personal loans in the double-digit interest rates, and if you don't absolutely need that money in the next 5 to 10 years, that's kind of the horizon that I like to look at it as. If you just have some extra money and you have already some cash put away for like an emergency savings, then heck yeah, why not put more of that into something when you have a really good idea and history's on your side that during a market downturn or during a bear market, this is where people get rich. They put their money in when other people have to be paying down their credit cards and things. And so you get to take advantage when the market's lower. And then when that thing rises back up, you've put all of this extra money in there. So now you're just going to get 3 times as rich. So dollar cost averaging, still, I definitely agree with that. You still don't want to just throw, if you have $10,000, you don't want to throw all of that in right away, even though you could, but it's still smarter to just, instead of doing that, do $1,000 every week for the next 10 weeks. Something of that nature. So definitely look at your personal finances, look at your personal goals, make sure it's something that you don't need money for now, because we don't know how long this market downturn could be. It literally could be another 10 years of just this, low that we're in right now, especially with the inflation and all this other craziness that's going on. It could be a while. I don't personally think it's going to be 10 years, but I do think it's going to be a couple years until we get this thing figured out and until the economy's back to booming the way that it was. That's just normal. It's normal market cycles. But all of this to say, be safe and make sure that you have a strategy and something that makes sense for you and for your family. And that's pretty much what I got for you today. If you have any other questions, I'd love to hear them. Throw them down in the comment section below. I'd also like to hear what you have to say about the things that I just talked about. And I'll catch you on the next office hours. Have a good day.